All right, let's go ahead and jump right into it on the investing when it comes to multifamily for beginners. And you'll definitely want to get all five of these insights. And actually, I'm going to go ahead and give you a bonus one for those of you who stay until the very end. And not many people know about these, and I wish I knew these when I first started out. So this will save you tons and thousands of dollars, and mostly millions of dollars, and most importantly, time. So let's go ahead and jump right into the first one, which is when it comes to investing in multifamily, is you have to understand the language and the terminology. And what I mean by this is it's known as COC, which is cash on cash return. And what this simply is, what is your return on your actual cash invested? And one rule I like to use when understanding the language when first starting out in whichever, let's say a multifamily, for instance, is Pareto's law, which is the 80-20 principle. And what this is the 80-20 principle is known as the 80-20 rule, which goes into roughly 80% of outcomes come from 20% of causes. And this also goes to understanding the language side of things, is you really need to know 20% to get going and breaking into this industry, and the remaining 80% is good to know. All you need is that the most important is the 20%. It's like learning any other languages. Really, we're only using throughout the whole words in the English language is only 20%. So that's first and foremost. So the first one is, as mentioned, the cash on cash, which in this is let's say you buy a property for $100,000, you put down $10,000 as the down payment, and the first year you cash flow, let's say $1,000. So on that 10,000 is you earned 1,000, so that is a 10% cash on cash. The next that you want to know is the NOI. These are the most important, is that NOI is the net operating income. So it's basically your income subtracting your operating expenses. And what operating expenses are just expenses to operate the actual property. And that does not include your actual debt. So you got your net operating income, and then your cap rate, which many are familiar with the cap rate, which is very crucial when it comes to valuing properties on multifamily. And I'll give you a example, is that for anyone who is especially investing in these properties, is use a calculator. That is, I would say, learn from my mistakes. The first deal, and I've worked with other investors that did not use a calculator. They bought the deal, and turns out they were actually losing money once they move forward with it. So let's go into when it comes to using a actual calculator. And here is one that I don't get paid by pushing this. It's free for you to be able to sign up on Bigger Pockets, and there's other calculators that you can use out there too. And this is just a sample of an underwriting deal that's in Indianapolis, but you can see here, what are your returns? So you got your NOI that's there. Here's the, for example purposes, the cash on cash, and then this is the cap rate that's in play. When you purchase it, and then also when you build out a model, which is a pro forma, which is forecasting how it's going to be. But when valuing multifamily properties, this is where NOI comes into play, and then also cash on cash as a example. Is that, let's use as an example, the property has an NOI of $30,000. An NOI of $30,000, and then cap rate is, let's say, of properties that are selling for that property that you're looking to buy, is, let's say, a 5% cap rate. So what you would do is, on the calculation side, is you would take 30,000 like this, divided by 0.005, and then you can back into one. See if I did that right. Yes. Okay. Yes. Let me go ahead and do that one more time. All right. 30,000 divided by 0.05. Okay, there we go. That's more like it. Okay, thought that was a little off. So you'll see here is a value of $600,000. So one, that can be, okay, this is how it's performing right now, and now you're making an offer on it. Or if you've already bought the property and you plan to push up the net operating income, for example, to $30,000, you would say, okay, in the future, this is going to be the value of the property. So that's very key to understand when it comes to understanding the language, and then also how properties are valued when on the multifamily side. So next is you've got to have your investment criteria. And this allows you to be very focused on your deal searching. That way you don't take the shotgun approach and you take more of the sniper approach. And it really helps when you're networking out there with, let's say, other investors that send you deals, or let's say it's agents, or let's say it's brokers as an example, is that you got to have your criteria dialed in. And that goes example is that my criteria is that in the Midwest, apartments between 75 to 160 units that are B class properties. So, and what this also goes into is you got different classes of properties. Is that you can have an A class property, you can have a B, you can have a C, you can have a D. So I'll just go back to my example. My criteria is B class properties that are in B minus to B locations, and with rents between $800 to $1,100, and they have to be predominantly 2 bedrooms. So that's a example of really having your criteria dialed in, and then from there that's when you can reverse engineer and start to be focused on when you're looking to actually acquire these properties. And at a later point, we'll go into the strategies that you can use to actually start to get these into your pipeline. So that's first and foremost, is have your investment criteria dialed in, because the common mistake I see people make, please do not run into this, is they get the shiny object syndrome. To where they say, well, I want to be in multifamily. Well, I want to be in mobile home parks. Well, I actually want to be in self-storage. So sticking to it and being patient with that investment criteria. And then once you master it, that's when I would say is to move on, let's say, to C-class assets, or maybe you go to A-class assets, or maybe you go to a whole entire different sector. So there's that. Your next is you gotta have your goals. And if you're getting value from this, go ahead and hit the like button. I'm going through this as to really get you the content. That way you're able to digest it and make this very simple as possible. So hopefully you're getting value. If so, go ahead and hit that like button. So the next is you gotta have your goals in play, your target, meaning and this goes back to the investment or earlier when we were talking about understanding the language, is what return on your money do you want to have? Do you want to have, let's say in 3 years, when you sell the property, you want to double your money? Or let's say you want to have double-digit returns on the your cash on cash, So these are, once you have these goals as an example, now you reverse engineer and you underwrite deals to fit that model. And this is what I was mentioning earlier about this calculator. And as I alluded to, is this is just one calculator. There's tons of ones that are out there for free as well. So from this is, once you have that criteria, such as, okay, this is what I want to a annualized return of, let's say, 20%, and then the cash on cash you want to be, let's say, 10% or in the double digits. Now you will look for deals and underwrite deals that fit that specific criteria. So now you're just reverse engineering and saying, all right, this is my target that I want. And now you go out and search for those deals. And I'll tell you this is, you're going to have to look at a lot of deals, especially today, you're going to have to look at a lot of deals in order many times to find that gem that actually works for you. And I tell you now is just to be patient when it comes to that. The common mistake I see people make is they, force themselves because of lack of patience to get into a bad deal. and they won't underwrite it properly to where they say, well, I'll manage the property myself, so I don't need to put an allocation for property management company. Or let's say the repairs and maintenance, or let's say the vacancy. This is a great example. They think that the property is always going to be 100% occupied. That is, in a perfect world, awesome. But as an investor, you got to protect your downside. Please, please, please listen to this. This is why I don't have as much hair, because I express this quite a bit, is you got to protect your downside when it comes to investing, because it comes to a risk versus reward. And I'll give you just a quick story when it comes to the risk to reward. Is I was speaking with a investor, and they just wanted some feedback on a deal, so I was helping coach them along. And they said that they were going to sign a corporation with their employees onto one of their properties, so they had multiple units within that property. And I said, did the contract get signed? They said no. And I said, if the contract doesn't get signed, because what happens is with the corporation is they would be paying premium for the rents above market. And I asked him is that if that corporation does not move forward, how does it look on the numbers? And he said they would not buy the deal because it doesn't look that good. And that's a prime example of not protecting your downside, because the deal looks good. If all goes well, perfect, all that, corporation ends up moving forward with renting the units to the employees. But then if it doesn't go through, then the deal is not good. So the downside is not protected on that. And that's one thing, is you want to have a more aggressive model when it comes to this. And then also you can have a conservative model, and ensuring that the conservative model is still good, or if not, a home run, which is ideal. But if not, it's still a good deal in that case. So we've got your goals. What you want is your return on your investment. And then the next, and then those of you, go ahead and comment below on, have you been able to get your first deal? Or is this your next deal that you're working towards? So there's that. The next step is you gotta outreach for the deals. And that's why it's important, in my earlier point that I mentioned, is the investment criteria. And there's two simple ways to find deals. One is you either go on market, or second, you either go off market. Two ways. On market is through brokers and agents. And simply through that route is you're establishing relationships with agents to send you deals. And that's why you want to have your investment criteria. So when you're having these conversations, is you say, I want multifamily properties between 5 to 15 units that are in, let's say, C neighborhoods that have some hair on them, meaning that not literal hair, but is that they need some work. And then now, as the agent is out there, they have you in mind that, oh, so-and-so, John Smith, is looking, why'd I use that common of a name? That's always a very common name. Is that, let's use another name, Joe Smith. So let's say now they go out and say, okay, these are the types of properties that Joe Smith is looking for. Let me go ahead and send those back to them. And so that's why it's key to have that. But as I've experienced, especially, is that going on market there's a lot of competition. That's why my preference is actually going direct to the owner and actually going off market. So we talked about on market. And then the second is off market, which is just simply beating the agents to the punch, you would say, to get the deal before they actually get the listing and put it on the open market, which when it comes to the open market is not only are you dealing with local buyers, you're dealing with buyers across the country and now international buyers. And the common thing is that I wouldn't say most, but when some of the competition that's out there is willing to just park their money and not too concerned with the return. So how do you compete with that? It's very difficult to do. So outreach for deals. So when it comes on market, and this is what I actually help investors with, and go ahead and click the link below if you want to hop on the call and further go through this. But off market is building your own list and then doing the outreach. It could be via calling, it could be via direct mail, it could be text, it could be email. So that's that route. It takes longer going the off-market approach, but you save money. And the investors I've worked with have saved millions of dollars, hundreds of thousands, and millions when it comes to taking the direct to owner approach. But it is more work, and that's why most actually prefer to go the on market, because they may not have the time to actually build everything out. But I say personally that it is worth it on the savings that you have, and there's also less competition. So there's the outreach for deals, and then also money. You got to have money to be able to fund them. If you don't have it, if you have it yourself, awesome. It's just you have the purchase price, you have the down payment, and then that comes out of your pocket. But for those of you who are just getting started and you know the route of, okay, having your own money, and you ask the question, well, I don't have my own money, the next step that you can take is actually to partner with people who do have the money. Okay, this is where I was going to do it for you. So in order. There it is. So this very first, or let's say this, what I was going to mention to you. So this is a multifamily property. This is a 9-unit in Indianapolis, of which it all started with a cold call direct to the actual owner. They were motivated to sell their property. This is another key thing, especially when going off market, is there has to be some type of motivation. If someone is just open to selling their property, or give me an offer I can't refuse, then that's likely just not going to end up working out on the numbers. So this particular individual they wanted out of the property because they moved from Indianapolis to actually Florida, and they were wanting to retire, and they had their son managing the property, which their son just couldn't keep up with it. So a lot of the pain points kept going up to the father. So that's why he ended up deciding to sell. So on this particular deal, ended up closing it. No money that was out of pocket on this specific one. So there is those types of deals, and with that is ended up partnering with someone who brought the cash. We closed on it together, and shortly after that, we ended up selling it and had a really good profit on it. So that's what I mean when it comes to it doesn't have to be your cash, and that is there has to be some type of value exchange when it comes to this, because if you're let's go ahead and scroll through. It says 10 units, but it's actually 9 units. And so just going back, is there has to be some type of value exchange. So if you don't have the cash and you're partnering with someone who does have the cash, you've got to bring something to the table. On this particular one I brought the actual deal, which finding deals is very difficult. So that was a lot of value that was brought, and they actually brought the cash. On my very first ever deal that I bought, which was a single family house, it was the same exact thing. I didn't have the cash. I'll tell you all, I had negative funds in my bank account, just not being financially smart. And what that is, I found someone who had the cash but didn't have the time to find the deals. I had the time but didn't have the cash. And then I ended up finding the deal for him, and there we go. And I got thrown into the fire to go figure everything else out. That's a whole nother story in itself that we will not get to. But one thing I wanted to share with you is, if there's a will, there is a way. And there's no excuses when it comes to this. I came from Section 8 housing. I could use that. I grew up on welfare, used that as an excuse, and was broke when getting that first deal. But I looked at it as, okay, this is a problem to be solved. Let me go ahead and find someone where I can solve their problem. They can solve my problem. And that's how that first deal came together. And then the last but not least is the team. And this is very crucial, is you don't have to do it all on your own. And there is a lot of moving parts when it comes to this industry. I've got to figure out a way to easier do this, but there's a lot of moving parts when it comes to this industry. So you've got real estate agents that you have on your team, a contractor, especially if you're going in and you're buying properties that need work, property manager. This is huge. And you can really rely on them, especially if you happen to not be investing in your backyard and you're investing from out of state. Property manager is huge. They're really your boots on the ground. Wholesalers, this is will help on the acquisition side, and this is and you got your attorney, your handyman ongoing. Especially if this is a buy and hold property, there are going to be some things that end up coming up that need to be repaired. An accountant on your team. So those are just several people that I just want to mention that do come to mind. And there's more actually that come to that as well. But I just want to allude to you that you don't have to do it all on your own. That's where the team comes into to play. And what I've personally learned as the experience here is that is putting people around the weaknesses that the areas that you're weak in, and just focusing on your strengths, because that will allow you to end up going faster. So that's all I have for you. Really want to get it in and out for you. No pun intended when it comes to that. I will go ahead and see you next time around. Go ahead and and subscribe as well as those of you on the YouTube, and appreciate you so much. Keep being awesome and working towards becoming the strongest version of selves. Thank you. All right.